Today on the Income Flip, I have Luis Belmonte, all the way from beautiful San Francisco. Louis, thank you so much for joining us on the Income Flip podcast.
Thanks for having me.
Man, listen. You've got a lot of experience, and I always love to tap people that have a lot of experience in this business. And so, how many years, Louis, have you been a developer now? And let's learn a little bit about your origin story.
Since 1967,
1967, right?
since the earth cooled. I'm older than dirt.
You invented the dirt. No, that's awesome. That's awesome. Well, what did you start off as a developer, Louis, or did you start on the brokerage side? Help me understand your journey and your path.
Well, I did. My father was a civil servant because his experience in the Depression is such that he really wanted a regular paycheck, but he always had side gigs, so rent houses, duplexes. And my folks divorced when I was young, and I went to live with him when I was 16, and I became an underpaid ranch hand, property manager, handyman, and income tax preparer. So I had some background in the property business, and he died tragically young of cancer, and the only thing I inherited, most of the estate went to my stepmother, but what I inherited was a duplex in Corning, California. And and I was about to join the Navy because it was either that or get drafted. And so I sold that to a local broker in Corning, California. $8,000, $800 down, and I carried the paper. So that was my first real estate deal.
I
And
love
there
it.
were
Owner
very few
finance
women in the
deal.
business in those days, and my God, she was tough. But So I went off to war, and after I got out of Vietnam, I started out with a corporate job, and a guy I lived with, a friend of mine from high school, was upside down a little real estate deal. He'd met some hippie in a saloon who would invade him to invest some of his inheritance in a two-flat building in the Richmond district of San Francisco. And it was a reasonably good deal because San Francisco in those days was gentrifying. The middle class had moved out of town in the 50s and gone to Daly City and Marin County, and some of them were starting to come back. And I was familiar with the program because when I was in a training class in Virginia Beach, I'd go to Georgetown on weekends because Virginia was dry, and in search of alcohol and women. And I saw what was going on in Georgetown. So the same sort of thing was happening in San Francisco. So it's a reasonably good deal, but no work was going on. So my flatmate was afraid he was going to lose his investment. So I said, well, I don't like my corporate job. You pay me $3 an hour and I'll strap on my tool belt and we'll go finish this rehab and you'll get your money back, which we did. And eventually I bought out the partner, and we finished the building and sold it, made a little money. And then he and I went into business together buying beat up deals. And our next deal was a two-flat building where the foundation had collapsed, which drove off most of the buyers. But one corner of the foundation had settled, and I went to the equipment supply and rented three screw jacks, and we jacked the building up a quarter of it, or an eighth of an inch a day so as not to break the plaster, and poured new footing, added some bedrooms, built new kitchens, put in fireplaces, and we did okay on that deal. And then we did a foolish thing. We bought a house, what had been a rent house out of an estate in the Richmond district of San Francisco, $28,000, 10% down, 2-year carryback, and we proceeded to create a masterpiece. And so we redid all the hardwood floors, put in a new kitchen, added a bathroom, a big deck, re-landscaped, and one of my jobs was the double hung windows, 6 panes on top, 1 pane on the bottom. There were 30 some windows, and I did a marvelous job. I set up a factory in the garage, replaced a lot of glass, glazing, prime and paint, wax on the casing, new sash cords, every window in the place, up and down, no problems. We had the best double hung windows in San Francisco. And then our 2 years was running out, so we had to sell it. And it turned out that we'd done too much remodeling for the neighborhood. Interest rates had gone to 9.5%. We didn't have the horsepower to keep the house. We had to sell it to get the next meal. It was a disaster. So we eventually sold it for $53,000 to a radiologist who put in wall to wall carpeting and aluminum windows. That's as, as I've come to crying in my entire life since I was 5 years old. I looked at those windows and tears came to my eyes. So, yeah, so I didn't have a proper exit strategy. I didn't do proper market research. I didn't have options for a downturn. And that taught me your ass belongs in the shallow end of the gene pool. Taste is not your business. So, today, most of my life I spent building warehouse buildings all over the world. Right now, in my old age, I'm a partner in a little company. We got dingbat neighborhood retail and low income housing. We have nothing in the taste business. We had, at one point a few years ago, we bought a beautiful bank building in downtown Portland. I mean, truly spectacular, turn of the century, marble columns, just an artwork. And we managed to break even on the sucker, pay our investors the return we'd promised them. Didn't make any money, and I hit myself on the head and said, "Once again, dummy, you've forgotten the lesson. Stay in the low end. That's where you belong. That's what you're good at. Be the the low cost producer." And so that was kind of the beginning of what went on. So after that house, I got married. My wife got pregnant. That's the way we used to do it in the old days. I realized I'm terribly to say, but there it was. So there
So,
was some pressure for regular income. So I went to the headhunters and got a job with a New York-based warehouse development company, and I did not know a warehouse from a whorehouse, but they were offering more money than anybody else, so I figured, okay, I'll learn the warehouse business. And I spent the next 35 years managing warehouses, operating warehouses, building warehouses, rehabbing warehouses, financing warehouses, leasing warehouses, and I did over $2 billion worth of deals. First in Northern California, then around the United States, then Mexico, Japan, Singapore. And for two employers, I did that until 20 years ago when I turned 64. And it was decided I was getting a little old to be an international road warrior. So I retired and started my little development company with a friend of mine. And that's the whole story.
well, I love that story. What is it? What does the development company look like today? Do you guys focus? It sounds like you focus on retail and warehouse. Is that right?
Well, no, we have one warehouse deal, but mostly
Okay.
we're retail and low income housing. And
Okay.
the reason below underlying all of that is that we started out with a limited amount of capital. So what do you do with a limited amount of capital? The first thing we did was merchant building. We built 30 drugstores for Walgreens. So build them and sell them. And the way it worked was we'd establish a relationship with one of their reps. We'd find a site, or they'd tell us they wanted a site. We'd go look at it. And what we specialized in was sites that were difficult to entitle. So we were bringing big league expertise to a small time business. And and the reason that Walgreens selected us to do these deals is they didn't want to try and entitle them themselves, stand in front of planning commissions at 2 a.m. and get their brains beat out, and we were good at it. I mean, I came from an environment where I was doing $50 million deals, $100 million deals. Now I'm doing $5 billion deals, but I'm good at it, and so the trick was we took the tough deals, and that way we were able to make a spread. So what we tried to do was build them with a 200 basis point spread between yield going in and the yield going out. And so that way we built a capital base. And then we started doing low income housing because when we started, the rest of the markets were in the toilet. So we're kind of looking around for what is the supply demand balance out of, and that's low income housing, and
Yeah.
it's very complicated. Involves a ton of lawyers, accountants, tax credit people, private equity, layered financing, and but if you do it right, you don't invest any capital at the end of the day. I mean, it takes a little front money to pay all the fees and get things teed up. But once you close, you get all your money back. So you got, in effect, a zero investment at the end. And it takes a while to make it profitable. But our oldest building now is 25 years old. It's a cash cow. The other one's about 15 years old. We're getting to cash cow position, and we essentially have no investment in the deals and a lot of write off as a result. So we do that, and then the retail came about because we did the Walgreens. We had excess land, and we'd sell the Walgreens, pay off the dirt free and clear, and wait till the opportunity arose to build out the rest of the site. So we've got 8 deals in Oregon that were, well, most of them were originally Walgreens deals. And then once we got in the flow of the business, we saw opportunities to buy beat up centers and put lipstick on the pig. So we have 3 centers now that we bought that were in tough shape and needed work, and so that's what we're doing. So what I'm looking at is where can a small scale player play, and I don't want to write checks and try and do deals against people who are writing checks with other people's money. So we're below the radar, and we're bringing big time expertise to small time deals, and that's our mo. And we got our portfolio is a couple of $100 million, about 40% levered.
Mm,
We're just operating in the fringes here, and I don't want to go big time. Most people who call themselves developers today are indentured servants to private equity or
yeah.
various institutions. We have a few investor friends in some of our deals, but we don't write no reports to nobody. And our investment committee is binary, thumbs up or thumbs down. As opposed to 4-hour meetings with 300-page analyses and charts and graphs and all that horse hockey, which I just have no patience for.
Louis, I love this so much because what you can do for a lot of people listening to this is maybe help some people listening that are going to pay attention to compress time a little bit, because over your career, obviously you learned where you fit in the niche of real estate. Real estate's a really, really big word. You understood like where you fit in that world. But then once you understood where you fit in that world, you you're now, I could hear it, you're having fun playing a game that you love to play, and you've found your niche in the world, which has created a lot of freedom for you. And this podcast is all about helping people understand how to kind of create what I call the income flip, create where your money and your assets are kind of working harder than you are. What advice, that all leads up to, what advice would you give your younger self today, knowing the path, so that you can kind of compress the time? And obviously, this is just speaking directly to you, right? But there might be others listening that can learn from that, right? And there was lots of mistakes I'm sure made along the way. So I want to get some like lessons learned, mistakes that we can avoid, but also just like what you wish you would have done sooner and like stamped out like the money making machine sooner. If you understand what I mean.
Yes, I do. Yes, and I actually occasionally teach class at Stanford Business School, and I used to teach a class at Haas Berkeley School. And what I tell the young people is the first thing you got to do is know yourself, know
Mm,
what you're good at, and know what you're not good at. So I had a chance to really be in the big leagues, and but what I found is I valued the freedom more than I valued the scope, more than I valued being a big dog. So in the great high rise of life, I don't want the penthouse. I want to be two floors down with a good view and no mortgage. So, I don't want to be high profile. That's number one. Number two, figure out where your wheelhouse is. So my wheelhouse is I'm a developer. That means I'm a sociopath. I don't believe in rules. If you say no, I'm going to find a way around it. If you put a rule in front of me, I'm going to say, well, can I break the rule and get away with it, or can I pay the fine? Keep out is my incentive to go in. So and in order to succeed as a developer, you have to be an inductive thinker. You got to be willing to see what isn't there. And I'm not a great inductive thinker, and I look to steal ideas all the time. When I see a developer who's done something that's truly innovative, because if you do Me Too deals, the margins are all gone. You got to think up something that's a little out of the ordinary. You got to bring change that creates value. So you have to be an inductive thinker, and you have to have what the shrinks call low socialization. Because if you take no for an answer, you're never going to get there. I
Hmm.
mean, everybody hates developers. If you watch mystery shows on TV and there's a developer in the cast, that's the murderer. Except for one show I saw where the developer was murdered and it turns out he deserved it. So, you're going to get pilloried, you're going to get bad publicity, you're going to be abused in front of planning commissions and city councils. Nobody likes change, nobody wants to see you. So you're going to be one of life's villains and you have to not care. So if you have high socialization, you belong in sales. If you have a high sense of responsibility like police and social workers, you belong in property management. If you're an inductive thinker, you belong in finance. If the idea of standing on a doorstep demanding the rent or unplugging a toilet disgusts you, don't get in the residential real estate business. So it's you figure out what you're about before you enter the business. So if you're good at analytics, then you look around for arbitrage. So that you can take advantage of arbitrage. So when my company, which is now Prologis, went public as A&B Property Corporation, there was a spread between what the private markets were paying and the public markets were paying. So we went to all of our institutional investors that we were advising and said, give us the deeds to your property in return to stock in our company because you will get a 10 to 15% pop because of this arbitrage. And the managers of those funds made their bonuses based on their valuations. So, that most of them signed up. And and I don't take credit for this. The boss man, Mogadam, was the strategic genius for seeing what was going on in the marketplace. And so the next big lesson is everybody is happy in real estate when times are good. Rents are going up, vacancies are low, financing's easy. And so that's what we focus on. You should focus on recessions. So when I'm remodeling the house, I should have said to myself, what happens if we hit the market when the interest rates have spiked? What are we going to do? We didn't have a plan to turn it into a rent house, to carry it. We didn't understand how to do financing. We didn't understand how to raise equity. We could, and we didn't understand the state of the marketplace. So if we had gone in done a quick refinish of the floors or put some carpet in, put some white paint on it, added the bathroom, which it needed, and got it in generally good shape. We could have sold it for, 45 grand and been in it 35 grand and happy days. So you always got to assume the downside is coming and plan for the downside and plan for exits. And when you're doing a loan, don't go floating rate, go fixed, go as far as you can, get rollover options, subdivide everything you can subdivide so you can sell off pieces. Just assume that bad times are coming because they always do. And if you get it right, then you get to the point where you not only survive the recession, you take advantage of the recession. Because, as my former boss used to say, big money in real estate is made by those who have cash when nobody else does. So, right now, office buildings are selling in San Francisco for 20, 25, 30% of replacement cost. And write downs are massive. And if I wasn't so old, I'd be an investor in one of those deals. But it's going to take 7 years for the payday to come. And I'm past my due date already. I don't even buy green bananas. So I haven't invested. But the deals are there,
Yeah.
and 2000, when the subprime market collapsed, you could buy good houses for 50
Yeah.
cents on the dollar, and I
I
if
did.
I hadn't been so old, I'd have bought a lot of them. I only bought one, but people I knew bought a lot of them and
Mm.
did just fine, and companies evolved now. And my mistake there was I thought, okay, I've got 500 units of multifamily and in two projects. I know how to run 500 units. You got a manager, an assistant manager, a couple of maintenance people to do the turnovers, and you're there. How do you do several hundred houses? And I thought, God, the management's going to eat these people alive. But if you have surveillance cameras, GPS, roving maintenance teams, remote pay rent, you can do it. And they did it. And I didn't trust technology enough to say you can run 200 houses almost as cheaply as you can run 200 units. So
Yeah.
that was a failure on my part. But in any event, those are the opportunities that come along. And I own some units in Oakland in 2007, and I'm listening to country music on a radio station driving down the Nimitz Freeway. Somebody comes on and tells me they're going to lend me 125% of the value of my house in the form of a second mortgage. I thought, the world's gone crazy here. This is nuts. So, I'm not doing all that well on these units. And so I get a little pricing data and I think, I can make a pop if I sell these things into this dumb market of ninja financing. To hell with it. So, I got a broker who specializes in kind of the dingbat units I had. We did 9 deals in 90 days. And the
Wow.
last one was 100% financing, 100% financing. And the people were going to move into two of the four units in a 4 unit building. They weren't going to last 3 months, but they gave me 800 grand for 4 units. Just take the money and run. It was insanity. And so, go someplace else and have cash ready when the time comes.
Wise words, right? So you saw the and by the way, this is for anybody listening. Ray Dalio talks about this all the time. Like history has a way of repeating itself over and over again. And so I'm sure one downturn that maybe happened in the past alerted you to the next downturn and what to do better next time. And so you saw the warning signs. You said, hey, this doesn't make sense. I'm going to sell into it. Did you ever sit back, though, after you sold them a decade later and say, damn, all those things came back. The asset values are back. I would still own that asset today. I killed the asset. I killed the golden goose. Or were you happy that you took the money, and had it?
Pigs get fed, hogs get slaughtered.
Oh, yeah.
And, you never go broke making money. I took that money and did something better with it when the time was right. So, the trick is to always be indifferent. And remember, don't fall in love with the bricks and sticks. If the market is offering more for your bricks and sticks than they're worth, sell. If the market is offering less than the bricks and sticks are worth, buy. And so, the whole object in life is to buy low and sell high, and most people end up doing the opposite because they get depressed. And So the reason that my company went public is we were an advisory company. And we decided, and the early 90s were for commercial real estate were a complete disaster because of the 86 Tax Act, put every developer in America out of business. They were all bankrupt whether they knew it or not. The only totally true thing Donald Trump ever said was it was like going through the windshield, and that's the way it was. So I'm working on the other side of the table with the money side, and we're out buying things that we think are properly priced on behalf of institutions. So we decided an investment committee, and I'm there, I'm giving away IQ points to everybody else in the room, but we decide that Silicon Valley has been beat up beyond the point of rationality. So my boss goes down and ties up a bunch of buildings. He ties up a bunch of warehouses and a bunch of R&D buildings and takes me down because I got to run the real estate after he closes it. And I look at the warehouses and I say, right in my wheelhouse, bread and butter. I can fill these things up with one hand tied behind my back. Then we go look at the R&D buildings, and it's third tier at best, 1.5 stories under park, secondary locations. I said, God, I mean, I understand that that the market is prime for this, but couldn't you have tied up some good buildings? And he said, Louis, you dummy, this is what was available, and it's a timing play, meaning you dummy, you're supposed to settle the problem here. I'm buying this stuff at the right price. But we went out to the investment community, and nobody wanted to play because they'd been beat up in R&D buildings. So, people who bought gold at $1,200 an ounce in the 70s wouldn't buy it at $400 an ounce 3 years later because they'd been burned at 12. So he said, listen, we're not going to let this happen again. When we see an opportunity, we're going to be able to execute, and that's why we went public. So the trick is to not fall in love with the bricks and sticks. Figure out the valuations. The same thing when you're doing a deal, figure out how much work and how much risk you're taking in the deal and price it for that. So if you're buying a triple A building at Main and Main with 20 years left on the lease and cost of living escalators and a triple A tenant, maybe a 5% return is appropriate. If you're buying a pool hall in Barstow that doubles as a meth lab, you better get a 20% return because you're going to have to go out and buy a gun and hire a bodyguard, and the meth lab might get busted. So you need to get your money back in a hurry. So you got to figure out the risk reward in every situation.
Louis, you said you wanted to fly under the radar. You didn't want to be the top dog, but you did want to be the street dog, right?
Yeah,
Because you wrote a number of books, right? The Street
yeah.
Dog MBA, the Street Dog Manager, the Street Dog Negotiator. How did all that come about?
Well, what I decided is this is where my wheelhouse is. So I'm working for an institutional shop, then a publicly traded company, and the thing I bring to the table is the grit and the gutter, as opposed to the analytical skills and the credentials of my partners and bosses. So what they can say is, here's somebody with practical experience that can go out and solve problems. So before we went public, and we had, I guess we were managing like 100 million feet of space around the country, warehouses. And when institutions trade property with each other, they throw dogs in to get them off the balance sheet. So I became the highly exalted executive vice president in charge of every screwed up deal in the United States, of which there were. And when we first started up, we had takeover business, meaning the other advisor had screwed it up. So, and I loved it. I go out, I'm solving problems. I'm jacking up foundations. That's the kind of thing I like to do. So that's the skill set I'm bringing to the table. So what I want people to know is what it's like there. So if they want to do it, then you can see what it's like, what it takes to get to be successful if you want to get out and wallow around in it. And in Street Dog Negotiator, my main point is the greatest strength you can have is indifference. If you go into the negotiating room and you don't care whether the deal makes or not, then you're in the driver's seat. So if and so I got my needs. If I can get my needs and a few of my wants out of a negotiation, I will sign the paper, tell the other team they kicked my ass, walk out of the room with my head down, and rub my hands together outside and say I got what I needed. If I go in and is it clear to me that I can't get what I need, I just get up and walk out of the room, because I don't care. So if I'm a buyer, I got a price I can afford. So we're doing a Walgreens site, and I say, okay, I need a land price that's going to yield me an 8% yield at the end of the deal. If I can't buy it for that price, I ain't doing the deal. So if same thing when I'm a seller, I got a price that I think is fair for the asset. And if you want to buy it for less, you're going to have to go someplace else because I ain't a seller. I need to be, and that's the first deal. The house deal we did was where I couldn't be indifferent. I didn't have the skill set. I didn't have the financial horsepower to hang on. I had to do a fire sale in order to eat dinner.
Yeah,
So,
you
you got
fell
to
in
say
love
to
with the
yourself,
windows. You didn't understand the exit strategy. You over improved the asset. I
yeah,
mean, that was a lot. Yeah, that was your mini MBA. I'm curious,
yes,
actually. So, indifference in Street Dog Millionaire, right? The person that like loves the deal the most, or like it has the most emotion around it, it's like actually going to lose in there. You're going to have indifference, which, by the way, that also goes when you have a lot of options. When your lead generation pipeline is full, you feel like you could just go to the next one like that.
yeah.
There's that
So
too.
as a developer, I want to always be prepared to just go play golf. If the numbers don't work, the numbers don't work. I don't want to be forced to work for the overhead. So I got to set myself up where I can, if I see an opportunity, we buy it. So our last deal was all equity because the loan rates were the moon and the stars. So
Mhm.
we bought a little building in Bend, Oregon. That's an office building, for heaven's sake. Now it's a dingbat office building, but it's a little office building, so nobody was lending on office. The interest rates were high, so well, we just called up a couple of our investors and said, okay, we're going to buy this deal. We're going to put up half the cash. Do you want in the deal? And they put up the other half the cash. We don't have a loan. And when the loan market comes back, if we lease it and the loan market comes back, we'll put some financing on it, give everybody their cash back and go on down the road. But in the interim, no problem. We haven't got any loan to serve. So and starting 4 years ago, when interest rates were zilch and irrationally low. I remember when the prime rate was 20 and commercial loans were double digits. So, I said to my partner, we got to go as long as we can, as far out as we can with these interest rates. We refinanced the entire portfolio. Our shortest loan is 10 years. Our longest is 35. Our biggest
Oh,
loan is 35
fantastic.
years.
Oh my
And, and,
God.
uh, and, and I don't have anything rolling over until 37. And that's just the way I want it. And we
I
locked in
love it.
because I remembered when I worked for Lincoln Property Company, we had deals with Principal Financial Group, and they put up the money at a spread over Fed funds. But they had all kinds of funds, and you could go into term loan anytime you wanted. And I fixed $100 million of loans at 10% because we were fully convinced we'd never see single digit interest rates again. And and that was just not my personal stupidity. My partners were screaming and hollering, is it fixed? Is it fixed? Do we have the paperwork? Did we get it locked in? So when rates are 3 or 4 and at AMB now Prologis, my partner, after I left, was borrowing money in Europe at 135 for 7 years. He borrowed 500 million pounds sterling at minus 80 basis points. Minus 80 basis point. I wrote him an email and said, if they're paying you to take the money, why didn't you borrow $1 billion? I mean, it was just insanity. And at one point, I said, what are you doing these days? He said, I'm borrowing money. It's on sale. And so the trick is you look for what you need. If you get that, just go on about your business, but you need to be indifferent.
Louis, so indifference for the negotiation side, what is the main point of Street Dog MBA and Street Dog Manager?
The main point of street dog manager is if you're running an organization, you're the servant, not the boss. So, what you're set up to do is serve the organization, motivate the people who work for you, and if you think you're the boss, you're crazy. So, if you're looking for power and money, it comes second, not first. If you run a good organization, the power, the prestige, the money will follow. If that's what your primary goal is, eventually the organization will go broke. So my mission in life these days with my little shop is to support the people who work for me and appreciate their work. So if you know I drive to San Jose to our project and I see my two immigrant workers down there who turn over units, I go look at the unit they've turned over, and I might have a tweak or two here or there, but basically I want them to know that I've seen their work. I understand the level of work that went into that refurbishment because I've done it myself with these two hands, and I appreciate the quality of their work. You know, they light up like a Christmas tree because somebody has appreciation for what they do. You know, then I go see my manager, and she's working on collection efforts and evictions and dealing with the bureaucracy at the housing authority and the Section 8 people. And, you know, and I sit there and I talk to her about it and I say, I really appreciate all of the grinding you have to do to keep the money coming in. So, and you know, what's the support you need? What's the software upgrade you need? The same thing. What can I do to support your efforts? So, you know, we don't need any glorification for me because I ain't doing the work. You are. So my job is to support you. And if that happens, then magically the money comes in and the occupancy is up and they get a bonus and I get the rest of it and we're pig happy.
What about Street Dog MBA?
Street Dog MBA is about stuff that happened to me and lessons I learned. So
Mm,
the first chapter is about a bicycle. So I'm in the third grade, and my mother and I are living on welfare in Beverly Hills. So we got a lot of attention from the social worker, and they're paying our rent $75 a month and giving us $7 a week for food. And I want a bike. And there's no money for a bike. So, you know, I'm looking at the bike store and I talk my way into a job. So I go to work at the bike store on Little Santa Monica and Beverly Hills as a janitor for 40 cents an hour. And the owner of the shop has a used bike that he's prepared to sell me, and there's a price on it. So I figure out early on how many hours I have to work to get the bike. And so ever after that in life, I've translated purchases into hours. So if I want something, I got to say to myself, how many hours do I have to work to get this, and is it worth it? And in many cases, the answer is no. And then you translate that into deals. You got to say how much work, how much risk. So how should this deal be priced? What should the free and clear yield of this deal going out be? So if I had thought about that at the first house, instead of creating a piece, it would have been white paint and carpet because we could have made a great return with white paint and carpet as opposed to zero return with a work of art. So, and a lot more work. So you learn risk and reward from that lesson at 40 cents an hour times however many hours it was to get a bike. And in that particular case, I wanted my freedom. So it was absolutely worth it. I was pig happy to spend those hours to get that bike. And then you can translate that into $100 million deals. And there's a whole lot of $100 million deals going on right now that are way too risky for the return you're going to receive, or require way too much work for the return you're going to receive. And the big dogs are not thinking it through.
Louis, well, that's where we will take the conversation next. What do you see? What's the horizon look like for you? What's happening? You've got a lot of perspective. You've got a lot of context. What advice would you give somebody like me right? I'm 20 years in the business, and I see a lot of cracks. I see things happening. I see in the residential space, areas slowing down. I see commercials suffered. It's been suffering for a while. What's your magic ball, crystal ball tell you?
Well, number one, I don't think interest rates are going to come down. Everybody's waiting for, so the
Mm,
Fed's going to lower the rates 25 basis points. What you got to watch is the 10-year Treasury. And the 10-year Treasury is the operative number that all loans are priced off of. So, and we have $37 trillion of debt. That translates to 28 trillion if you take out all the intergovernmental stuff, plus 4 trillion of muni debt. So, and all that has to be rolled over. And we got a $2 trillion a year deficit. So, in my estimate, the Treasury's got to roll $7 trillion of paper a year. And that means investors are going to demand a after tax and after inflation return. So inflation's 2.5%. That means the 10-year Treasury is going to be 4.5%. That means loans are going to be 6.5%, and that's just the way it is. I don't see that changing in the foreseeable future. Number two, the world is becoming a more dangerous place. So it just means there's more risk involved. So when I first started doing deals in Mexico, the free and clear yields in Mexico were 300 basis points higher than the U.S. for the exact same product, and that's because they don't have rule of law. And the politics are corrupt, so you gotta have a risk premium for the same concrete. So it's that's where we are, and in the midterm, I don't see that changing, except maybe for the worse. Because if a Treasury auction fails and the Fed has to start buying paper, then Katie barred the door and interest rates will go up dramatically, which they did in Europe when an English auction failed and when Greece defaulted, rates went up. So there's that. And it's going to be a more difficult world because America no longer has the capacity or the will to be the world's policeman. So, that's just how it is. So the bad guys will keep raising hell everywhere. In terms of product, if you look at drivers, uh, uh, the best product right now, even though there's a temporary glitch due to low interest rates a couple of years ago, the drivers are industrial real estate because of reshoring and data centers, which are nothing but warehouses with no truck doors, and online retail is just driving things, and reshoring will eventually drive things. So that's where the good stuff is. Retail, because of Amazon, got destroyed. So we started out with like 3,500 regional malls in the United States. We'll end up with 800. Just a disaster. But it's been going on for years, and right now, the lowest vacancies of any commercial real estate are in retail. So if you are able to get good neighborhood retail that needs work, you could do some good because the demand is still there. It's not rising a lot, but it's still there. But the supply has been turned off for years. And the same thing will happen to warehouse. There was a surge of building when interest rates were low, but once you work through that, then the numbers don't work. So existing inventory will do fine, especially existing inventory close in because the online people are competing on delivery times. Multifamily, it's real easy. You can see the supply pipeline and you can tell where it's overbuilt and where it isn't overbuilt. There's still opportunities in supply constrained locations. So one of the things I talk about in Street Dog MBA is flat spots. So if you're in Denver or Dallas or Houston or Atlanta, I mean, you can get on a ladder and see the next state. And I mean, it's so easy to build. So you got to do replacement cost analysis. So when I was working in Texas, I was a buyer in the 20s and a seller in the 30s per square foot for warehouse space. Because if you buy in the 20s, you got some room. If you buy in the 30s, everybody's out building, and the buildings are soon going to be worth 20s. So it's a timing market, and and replacement cost is everything. So if you own something that's genuinely below replacement cost, that means that the next building can't lower rents to low enough to compete with you. And replacement cost doesn't mean new buildings cost $100 a foot and your building costs $80 a foot. You got to say to yourself, what would I have to do to make this $80 building equal in desirability to a brand new building, and that's
Mm-hmm.
typically going to be $20. So you can't buy at 80, you got to buy at 70, and then
Mm-hmm.
you got a floor. You can be the low price leader. You can offer rent that's much lower than the new construction and still make money. So, you know, thinking through replacement cost is where you want to be, and and so the things that go to hell in a handbasket are supply demand balance. And you can look at the pipeline and decide whether you're going to be overwhelmed. Demand is harder to predict. So you got, I mean, that's a loose cannon. It's hard. I mean, you can look at it, but it's pretty hard. But supply, you can figure out when you're going to have an oversupply. And
Yeah.
the other thing is a capital strike when you can't get money. So that means you got to be prepared for the capital strike and not have a need to go finance with your back against the wall if you can possibly help it. So that, you know, that's what's going on. And there's still things out there worth doing. And if you look at things imaginatively, you can go out and buy a piece of property and change it to the point where you can get a rise in rent. So, you know, when I first started buying apartments in San Francisco, I bought them from widows, and because they didn't have the ability to upgrade, and typically they hadn't raised rents in a long time. So, you know, I'd say, well, you know, here's a down payment to cover your closing costs, and you can carry back a mortgage, and I will send you one check a month that's the same as you were getting from all of these tenants, and you don't have to go collect it or worry about it. And then I'd go in and upgrade the units and raise the rent 40 or $50 a month. And that way I was able to accumulate enough capital to do the next deal 2 years later. So I'm able to add value. So you got to look at any deal and say, what can I do to add value and therefore create cash flow?
Yeah. I love it. Louis, if people wanted to get a hold of you, are you on Instagram? Are you on Facebook? Like, do
Hey,
people,
I'm
right?
almost 85 years old. I can't even spell Instagram. So L Belmonte at 7hp.com. Seven Hills Properties got a website. You can buy the books on Amazon. They're cheap. I'm certainly not making any money selling books, and that distills the lessons I've had. If somebody wants to ask me a question, I have an opinion on virtually every subject. As
I love it.
one of my partners used to say, not always right, but never in doubt.
But
And
never in doubt, 100% certain. I
yeah,
love it.
100% certain. So, happy to try and help anybody in the business.
Well, Louis, I appreciate your time. I just something I want to comment on. My dad is from the Oakland, California area. Also served in Vietnam, right? Which that area wasn't a super returning back from Vietnam to San Francisco.
Yeah.
That in itself was a tough thing to
And
do.
and and people would complain about it, and I say, well, I'm a trained killer. Don't screw with me.
That's
So
right. Anyhow, man, thank you so much for your service, Louis. Thank you for pouring into everybody here in our great community and those listening to the Income Flip podcast. There are so many golden nuggets that I've pulled out uh, that I'm going to apply moving forward for my next 20, 30 years. Right? I think I've got 25 years before I'm 65 before you
yeah,
hit your retire right before you hit your retirement. And so I know it's a game that I want to play when I'm 85, 90. Like it's just a game you can play forever.
our investment committee question is, will this deal be fun? If the answer is no, we don't do it. And if the answer is yes, we do it. And I consider myself the luckiest of human beings. I found a way to make a living that's so entertaining, I do it in my old age for giggles. And giggles are very important.